as we can see from the replies on this thread, this topic of landlords going head to head over leveraging, this has been one of the most hottest and trending topics on Property Tribes in recent times. Welcome again, Stephen. You've had a chance to actually read through this very, very long thread, hopefully with a nice cup of tea. What was your view of the overall tone of the conversation?
First thing I guess I would say is it's great that this debate's happening amongst landlords, and obviously, you know, both sides of the argument are there, and you can see with all things there are benefits and there are downsides. I just think it's a good sign that people are having quite an in-depth conversation about this, because it's critical, and especially as we look at kind of the future interest rate environment. You know, the people should be focused on this, and they should be thinking about it and making informed decisions really about what's the right level of leverage for their risk profile. So firstly, I think it's great that this debate's happening. I guess in terms of the debate, I was going to kind of come at it slightly differently. I was going to sort of maybe list out what I think the pros of leverage are, and then what I think the downsides are, and then I'm going to conclude if that's okay.
Yeah, please do.
So firstly, starting with the benefits of leverage, clearly, in simple terms, it improves the return on your capital. So with a bit of leverage, you can actually make your money work harder, and you can earn more from your equity. It's a very, very simple principle that kind of pervades all of businesses, really, not just landlords. I mean, you know, some high-profile examples. Manchester United's a classic example with the Glaziers. They used, you know, heavily leveraged to effectively buy the football club and do very well for their equity, basically on the back of debt, and they've used the cash flow from the football club to sort of service that debt. So leverage is a key principle in most businesses, and it can certainly help excite the returns from your own sort of, you know, your own capital. It helps you grow a larger portfolio. The larger portfolio should yield investors greater cash flow. So if you're driven by kind of yield and cash flow, then a bit of leverage should also help you to get greater cash from your portfolio. One of the things so they're the kind of sort of benefits, really. I guess the downsides is your ability to withstand shocks, fundamentally. What does that shock look like? Well, interest rates is a classic. You know, you're going to have to service your debt irrespective of whether property prices are going up or down, and it can really affect the economics. So I've done some numbers, and whether these might sort of shock people or not. But if you were paying 7% cost of debt on your portfolio, and you were borrowing at 75% loan to value, you'd need to be getting about 6.6% gross yield on your property just to pay the debt.
Wow.
So that's quite a scary number, and that's that's a gross yield before you've had any cash flow for yourself. So effectively, all you're generating after your wear and tear and some of your costs is going to be servicing debt, and you're going to be getting no cash flow from it. So I think landlords just need to think about it in those terms, because they'll probably be very, very focused on the yields they can get from their portfolios, but they should think of it quite closely when they're looking at the debt levels. Now, that doesn't take into account any problems. So when you get voids, you've got real problem tenants that are in the property not paying, you can't get them out. So the landlords will be very, very aware of some of those pitfalls that are out there. House prices go down too. So people talk about leverage and as a one-way bet. Your debt level won't go down, but property prices can. So, especially in the short term. Longer term, clearly the trends are always pretty positive for property, but your debt will be there and you'll have to service it no matter what happens to your property prices. As a leveraged landlord, you're going to have to manage your banks and your lenders. So you've got a stakeholder there, and that does impact on your independence, your freedom, things you might want to do. You're going to have to bring someone along for the ride. If you've got plans to develop elements of your property, that can be severely restricted by the lenders and their willingness to allow that. So it does impact on flexibility. And if you're a highly leveraged landlord, you are going to be paying more for your money, and you may well be restricted in terms of what lenders, or if there are any lenders that will lend to you, because we as a lending community are nervous about highly leveraged landlords. Yeah. So that would be kind of the key cons on that side of the argument. Overall, I think it's a judgment call based upon individual landlords' appetite and their risk appetite. One point I would like to raise is, I know on the thread somebody said that leverage, one of the gentlemen said that leverage will prevent repossession. Just to sort of nip that in the bud, that's not the case. Irrespective of how much, there's a famous saying in lending, your first loss is your best loss. And with the regulatory environment that banks now operate in, you can't forbear unrealistically if you've got an impaired loan, you have to act quickly to protect the bank's position or the lender's position. So just because you're highly leveraged does not mean that a bank won't take possession. So I think people need to be very, very careful about sort of reading that. I know during the kind of credit crisis, when banks were very, very desperate to protect their capital, you could say there was concern that banks were being too generous and forbearing too much because they didn't want to realise the losses, couldn't afford to realise the losses. The world's moved on from there, and the regulatory environment and the capital environment is such that lenders have to act quickly and prudently to protect their position. So it won't prevent possession, and I think that's a dangerous sort of road to go down. Personally, I'm a landlord, and also as a lender that's lent through the cycle twice. For me, it's you've got to strike a sensible balance. So a good level of gearing will get you the best returns. If you push it too much, I think you're introducing a very, very significant amount of risk. And overall, a landlord geared at between 60 to 65%, I think, is a good medium space, which gives them the debt they need to grow the portfolio, but fundamentally the headroom to withstand shocks that can happen. That's my own personal opinion. That's not, that's just me as a landlord, and that's the decision I take. Well,
I think really what came out of it, and what you've said, Stephen, is that it's never a case of one size fits all, and that each landlord must fully understand their own personal circumstances and what other debt they have in their life, and manage accordingly. And unfortunately, a lot of the wealth creation strategies in property are to leverage up to the max, keep remortgaging, milking for equity. And I guess thankfully those are in the past, those days, because not many lenders are allowing constant remortgaging. But the main thing is that the informed landlord is going to be the landlord that survives.
Yeah, absolutely. And be clear about your risk appetite. What are you comfortable doing? Like any form of investment, when you go onto an IFA, you have to fill out a risk appetite questionnaire. It's the same sort of questions you should ask yourself. But come back to the economics. What level of interest rate, what kind of yield am I going to need to be able to service that level of debt? And that makes it real, I think, for landlords. So I think thinking about it in those terms would be good advice.